Welcome back to the Capital Mindset Show. We are your hosts with the most, Austin and Fabio. Today, we're going to be talking about GoPro, ticker symbol GPRO. So, I'm going to be the host asking all the questions to Fabio here, and then Fabio, with all the wonderful answers, as always, will be answering any and all questions. So without further ado, what are we looking at here today?
So, as always, actually, I think we should first go with a announcement or kind of like a commentary about our comment section. And we really enjoy actually when everyone comes on and comments their thoughts. We'll respond when we can, and even when it's a disagreement, we really enjoy those as well, because we're always going to listen to any thoughts. We want our channel to actually become a community of discourse, right? And where other people can kind of voice their opinions, because it is a market. And what does that imply about a market? Well, for every market, there's a buyer and a seller. There's someone who thinks positively about an asset, and there's someone who thinks quite negatively about an asset. And then
and it's and
it's like we want to promote healthy discussion about these assets. So always feel free to be to counter our points and or support our points, with additional information that we may not have discussed, because these videos, unfortunately, we are constrained by time, and so we cannot make them 3 hours long. It would be impractical. So of course, we're always going to skip over some things. We're not going to go as in depth. We'll try to go as more in depth than other channels. So it won't be like 10 minutes, because we saw the feedback from one of our videos. We want to encompass everything, so we may try to incorporate some short form, but clearly the long form is what we enjoy doing and what the audience here so far enjoys.
Yeah. And then also another important thing to note as well is that we're not trying to create an echo chamber here. So if you have a disagreement with us or anything that we're saying or talking about, please feel free to voice those, because like Fabio just said, we're trying to create a community of investors and discourse. We're trying to promote discourse. And so with that being said, let's segue back into GoPro here. What is GoPro as a business? Who are GoPro's customers? And then what is GoPro selling? Basically, so those are the first three questions that I have here today.
So GoPro, people may know it for their action cameras. That is a primary business from which they engage, and then they sell these action cameras through different peripherals. We'll talk about those peripherals later, because direct to consumer is probably becoming one of the most important peripherals for this business, and they're going to be highlighting it to us. So GoPro, we can see from its IPO, has actually been a very disappointing company. And I can tell you a lot of that, with context, had to do with the way the CEO was managing it. It's still being run by the same CEO and founder. And in the beginning, he was younger. He was living his life more, spending more money than perhaps he should have, and been more focused.
Didn't he take out a yacht off of the business or something? Wasn't that something that happened in like 2018? Something like that?
I wouldn't say it was off of the business, because that implies illegal and nefarious.
Okay.
I wouldn't imply that. And I wouldn't say that is actually true. He got it from his own money, but he perhaps should have not been going on the yacht, and instead should have been focused on building the business, right?
Yeah.
So that's perhaps what he should have been doing in hindsight. Okay. However, in the moment, GoPro was on fire. We can see that after the IPO, it rocketed up. We saw that you looked like a genius, because you were up 131% in a very short amount of time. But then if you were the buyer over here, or even over here, you held, you're now crying, right? Now, the story changes in 2020. If you somehow knew that would be the low, you've done fantastic, 300, almost 400%, even more than back there. And if you believe the bullish thesis on the stock, you're probably going to maybe ride it out all the way. But we'll see. We'll actually explore that. And then, building off of what we said in the beginning, again, if you agree or disagree with our points here, comment down below. And then we may present our ideas in a more bearish light or a more bullish light than what you believe. And then that's what makes a market. So
kind of segueing back to this now, segueing to GoPro's products. So we know that one of their primary products is the action camera. From that, I've also been reading that they've developed video editing software. They've developed other peripherals that kind of support this action camera here. Would you kind of explore those and what the implications of a video editing software are? Basically, the question is, why should I use GoPro's video editing software instead of, let's say, Adobe Premiere or Final Cut Pro, something like that?
Well, affordability, it's a lot cheaper. And what they're trying to do is kind of integrate their products, make it seamless for people to utilize both their device and then a software that kind of complements that device. So if you believe that they're going to effectively execute on this, there is something interesting to be said about that, because it would be very convenient for me to buy the device and also have an affordable video editing software from which I can edit my videos and upload my action pics or whatever, action videos. And then I can share with the world, because the world is becoming a lot more shareable. Like we're doing that right now. We're sharing our thoughts on the internet. Some people like to share different things, right? Some people like to share what the flips that they did or the crazy stunts that they've been doing.
Okay.
And that's where GoPro.
So priming my thoughts here and kind of extrapolating meaning out of what you just said, the business strategy that we're kind of looking at right now is that they are pricing their products in terms of convenience and then also affordability. So they're trying to make sure that they provide a product that people buy. They take care of all of the other boxes. They check off all the other boxes people might have, but they do this at a competitive price. All right. I'm starting to understand the business strategy. Now let's kind of focus on who are GoPro's customers. And then also, have we been seeing expanding customer growth, maybe reflected in sales or cash flows, or have we been seeing actual customer decline?
So we'll get into the customer decline and growth later, but who the customers are people who enjoy filming their activities, right? So specifically think of action sports. And then you can kind of see here in the highlights right here, they have right here this woman surfing. And there's another dude surfing right here, right? So
yeah,
you see right here the camera. So that's basically even implied in the presentation of the product that that's what it's for. That's their target, right?
okay.
And I think for the most part, the audience kind of knows that's fairly obvious. That's what GoPros are utilized. They're supposed to be kind of more indestructible than, let's say, compared to an iPhone. You wouldn't really do this with your iPhone.
So it's almost as if GoPro has also been building a brand equity of sorts with consumers, exactly positioning themselves in this specific market. Hey, we are the go-to when it comes to action cameras. Choose
right
us.
here.
And that's what the
you can see that. So they have a very good following on social media. Instagram, that's very impressive. Facebook, I don't care too much about that one. YouTube, I care. So 10 million subscribers and 21 million followers. That's very impressive. Of course, Instagram and Facebook are the same. You know, it's one company, but
Facebook is important with the older generation. So I still would not discount the Facebook likes here, because what that kind of shows me is that potentially the older generation might also be interested in this product as well.
Yeah, so, but for the future of the brand or the product, I want them to be more. I want to know that they're also very influential in these two other platforms where the youth more congregate. So but yeah, I understand. Yeah, Facebook, yes, because there's obviously there's customers everywhere, but for the continuity of the brand of the company, I want to see them in these places as well. So here we have this is actually their business change, right? This is actually what I wanted to highlight. If you didn't know this already, GoPro before was hardware only. Now they're switching to a hardware subscription model, and then hardware subscription, then app monetization going forward. So we will judge them based on their transition. And sometimes when a company transitions, it could be for the better or for the worse, depending on the execution. So just something to keep in mind. Gross margins will naturally rise because software is higher gross margin than just hardware. So hardware has lower gross margins. And as I was highlighting before, I was hinting at that they were going to focus on the different peripherals in order to reach those customers. So before they were greater percentage of retail was 90+%. Now see direct to consumer has risen dramatically. Then what they want to do going forward is get that direct to consumer above 40%, which is possible because subscription revenue is going to be all direct to consumer. I go on the GoPro app and I subscribe, or I pay a subscription, and then that's direct to consumer. So that's going to skew the numbers a little bit there. I want
Wait,
them
hold
to.
on. Okay, all right. I'm trying to make sense of what this direct to consumer actual product entails. So one pays for a subscription and then you just have access to the GoPro app. Where is the moat here? Why wouldn't they just use YouTube or stuff like this? Or is this
Wait,
subscription
why would they use
then
YouTube?
allows well, because they already have a okay, so actually I don't think I asked this question. Like, what incentivizes a customer to pay for this subscription when they can just upload their GoPro video to YouTube
They
in
have
this
to edit it.
instance?
Oh, you're confused, Austin. It's not to
Yeah.
watch the videos. YouTube is to watch the videos. This subscription is for you to edit the videos.
Oh, okay. That's important because I missed that part.
So it's not a place where I would go to pay GoPro to watch videos. That would be pretty silly. It's a place where I can go and I can edit the videos at a cheaper price than something like Adobe. So Adobe Premiere. And then I can pay less and I can still kind of get the same features that I want. And then I can upload that to YouTube, to Instagram, to wherever I want. You know, the point is to share. GoPro is building upon that economy of people that want to share their life, you know, the blogging lifestyle. So they're trying to get into that niche where they enable people to do something like that at a cheaper rate than what others would do. And they're trying to integrate everything under one umbrella. So you just go to GoPro and GoPro can give you the device to do it, the software to do it, and, you know, some additional little accessories to go along with their products. So the app, the subscription revenue is going to be high margin. So if they're able to execute there, the value of the business will actually grow. Okay. One, it will allow for more stable revenue and expectations going forward. And it actually would yield higher cash flows when compared to just the hardware side of the business. But you have to keep in mind that they're probably connected. So if the hardware side of the business falters, the subscription side of the subscription side of the business may also falter. So we have to keep that in mind.
Okay. And then my other question here is, when it comes to execution on this vision here, you personally, do you trust that the CEO will be able to do this? And then if so, or if not, what are some roadblocks that you're seeing? And then what are also some tailwinds that you see as well?
So I don't know for the CEO. I'm neither no or yes. I'm leaning more on yes, because I feel that he's now more focused. And then as for roadblocks, it just depends on how many people buy the device, how many people are loyal to GoPro, which I think is good. And then the tailwinds, right? So the things that will help it go forward is the growth in social media, the growth in people trying to share their lifestyles. So you have the Instagram blogger that, you know, is the fashionista, and they can use their cell phone. It's fine. The cell phone is good enough. Then you have the person who's an action sports person. They are, you know, skateboarding, surfing, skydiving. They're probably not going to want to film with their cell phone. They're probably going to want to use something that is more durable, like a GoPro. So action sports cameras will always be for those people. Now, for something like what we're doing, we're not using a GoPro. We don't need a GoPro. We're not throwing our camera. We're not doing anything crazy where the camera may be damaged. So we're not going to probably be that target audience in the first place. But there are a lot of people, and for the foreseeable future, there are going to be a lot of people that are active, right? And those people that are active may pursue to use an action camera because their cell phone would be very costly, or more costly if something were to happen to it. And it's more likely for something to happen to that device than a GoPro. So, yeah, you can see here's some accessories you can buy. It's not really that important too much, but this is the name of the app, Quick. So we want to see subscriber growth there. And obviously, if you saw back here, the subscriber growth is there, it's 93%, but we got to make sure that, remember, it's going to be tied to the actual product of GoPro to a huge extent, because you would have a GoPro and then you utilize the software. I know a lot of people have multiple GoPros, like 4, 5, 6 GoPros, right?
Interesting.
Yeah.
Yeah.
And a lot of people like
use cases, I would probably assume there, everything.
Well, yeah, and they may use it for getting different angles, etc. People go nuts with this stuff.
Yeah.
All right, so here we go. So we have more. So you see, we're using the investor presentation for those of you who are new to our channel, because we want to see what the company wants to highlight to us. If what the company wants to highlight to us is not impressive, then that's a red flag, because we understand that this is kind of like a sales pitch to investors. But if we go through this and we're not impressed, we're not going to be interested in doing further research. But if we go through this and we're kind of impressed, then we'll do more research and we'll say, okay, what's going on here? And again, these videos serve as kind of like a deeper dive than some others. And then we'll look at the financials. The financials will tell us whether or not we want to do a really deep dive, and kind of, this is just to kind of see, okay, what does this business do? Because if you don't know what the business does, how are you going to make accurate projections going forward, or even think about making accurate projections?
Well, I mean, like, also, like, why would you even consider investing in a business if you don't know what the business does? You know, like, that's the foundational question. So it's so important to know what the business does, and that's exactly what these investor presentations highlight. Not that, you know,
No,
suddenly
their sales pitch. We got to be very careful with that.
Yeah. I was even about to say, not that, like, immediately, like, when you see the investor presentation, you're like, oh, perfect, now I understand, now it's time to buy. No, basically, you kind of want to read between the lines when it comes to an investor presentation, and you pretty much want to be, all right, what is management at this company highlighting? What do they deem is important? And then does that align with my own beliefs as to what I believe is important? Or is that actually something that is objectively not important? But please continue. There's just my little 2 cents there.
Yeah. So you can see here that they're trying to highlight what we were talking about before.
Yeah.
The point of their products, right? So versatile storytelling and immersive sharing. So you see that sharing economy, they want to enable that. They want to enable you to film something, edit it, and get it out there on your Instagram, on your Facebook account, on your Twitter account, whatever, wherever you want. And then here they have the classes of cameras. I won't really pay too much attention to that, but I can tell you this is actually quite cheap relative to other editing softwares. And this allows you to basically get discounts on their new products. So you see up to $100 off the new GoPro, unlimited cloud backup. This is interesting because this is now kind of giving you that subscription revenue for cloud storage for photos. I don't know if they're doing it themselves or they're outsourcing this to someone else. Could be one or the other. And then
that's something I would actually be exceptionally interested in looking into, if exactly as you just said, like, who is who's responsible for a lot of that, like the cloud storage backend, basically. I would want to see, like, who's partnered here and has that.
But so this is what's interesting. Full access to the Quick app, and you just pay $50 a year, basically. Okay.
Of a year. Wow.
Yeah. And then here you have versatile quick mobile apps. So if you don't want all of this is quite interesting. You can just pay $9.99 a year, right? See how cheap that is? $9.99 a year for just the video editing. So you pay $50 a year, you get all of this, and this is included in that. But if you just want the video editing, $9.99 a year, and that's a lot cheaper than something like Adobe Premiere. Probably they don't have the same kinds of features. It's probably, you know, it is, I think, just cell phone based. But for what it is, it's good. Okay.
Yeah.
All right. And then this is kind of like their strategy. So consumer, lifestyle. I'll let you guys kind of pause here because I won't spend too much time. And then here they're again focusing again on that direct to consumer. Right now they're heavily reliant on retail still, but direct to consumer is growing. Good for them. Remember that as the subscription revenue grows, that's actually going to skew the numbers. So we got to be careful with that. So we want to make sure that it's direct to consumer also for their devices. But check this out. So if they do the subscription up here, right, they're also probably going to buy it off of their website. These people the subscribers here are going to be likely to buy it off of the website, likely, right? And then you see here up to 50% off at GoPro.com. You see that? Boom, there you go. They're pushing it. That just tells you kind of like the full picture. And I think that's it for now. And we'll look at here, I'll highlight this because I think this is important. Revenues have been kind of flat. Net income actually has been going up because they've been improving some efficiencies. And then, okay, I don't really care about that. Okay, I really don't care about this. Who cares?
All right. Would you kind of give some context as to why you don't care about adjusted EBITDA? Maybe just for like a quick, like 2 minutes here.
Well, because
before we move on to the model,
interest and taxes are real expenses. They're very, very real. They're very, very real. If so, like we can play this game. EBITDA has a purpose, but it's misused. And it was designed in the 80s for a reason, for basically holistic acquisitions. And so it allows you to do like an EV to EBITDA multiple, right? If you're not using it in that context, it's kind of useless. But you should only be using EV to EBITDA multiple if you're going to be buying the entirety of the business, or you're thinking about it as kind of like a business that another person would acquire or another entity would acquire, because an EV to EBITDA multiple implies that you're going to pay off all the debt, and you're going to get, and the cash is going to be distributed to the current owners, and then you're just remaining with the business. So you'll in theory have no interest at that point because you're paying off all the debt. So you're including the costs into it, and then you're just taking the EBITDA from it. And then depreciation, amortization, they're not cash expenses. They're real expenses, but they're not cash expenses. So just taking that into account, you're not actually properly reflecting those real expenses that have to be made to maintain the business. Therefore, that's kind of stupid. And the net income takes into account depreciation, amortization, and some people like to dismiss it again because they're not cash expenses. But if you take, for example, the free cash flow method, you are then bringing back in through CapEx the necessary investments that a business needs to make. So EBITDA ignores those necessary investments, and it for some reason you're making the logic that you should ignore the interest expenses, because let's face it, you're not buying the whole business. You're not doing what EV to EBITDA was designed to do. You're not doing that. You're buying a share. So you're using the wrong metric to really think about things. And interest expense is a real expense. Tax expense is a real expense. If you want to play that game, okay, fine. How about this? Austin, I'll give you $100. And then from that, I'm going to take away $60 for taxes. And you also owe me $40 in interest. Thank you. How much did you make?
Yeah, nothing.
Oh, no. Your EBITDA is $100, my friend.
Yeah.
Now let's go pay a dividend with your EBITDA.
You can't. Yeah.
You see. So like I'm giving an extreme example where I'm taking away everything from Austin. Obviously, it's not that extreme, but we can see with that example that the EBITDA is useless to Austin. He can't pay himself a dividend. He's literally has $0 in cash because he's paid his interest and his taxes, right? So why? I don't know. But well, the answer is because what it was designed to do, but people misuse it. And when they highlight it too much, that's a red flag to me. Because EBITDA is always going to be higher. So red flag when they highlight to us. They're not shoving it in your face. I'm not saying that, but I don't care about it. All right. So this I care. Okay. All this is good. So this is all giving us an idea when we go into the model of what growth rates we may want to assume going forward. If you go into the model without knowing that, it's only going to be as good as the inputs you put in. Okay.
Yeah.
So if you go in with no idea of what you're doing, no idea about what the business does, how are you going to ascribe a decent growth rate? We're not saying you need to be an expert at GoPro. You need to know everything about GoPro.
You got to have a little foundation, and the foundation can't be built on sand. You got to like a little tiny foundation. Yeah.
You got to know what's kind of going on. And then you can make accurate projections or somewhat accurate, because you're not going to be accurate. That's why there's a range of projections that we're going to make. But you got to be somewhat. All right. So let's actually get started. So GPRO. Okay. Hopefully it comes back quickly. Port everything in. Oh, it's here. All right. So let's look what the analysts say. The almighty analysts. Analysts rate this company as a hold, and with a price target of $11.80. All right. Therefore, I'm going to pour all of my money into this company so I can make my $11. 11%. 11% rate of return, because that's market beating returns, Austin. Don't you know? All right. Anyway, so are the analysts right? So let's do market rate of return. All right. Boom. Right there. There's your answer. Market rate of return, assuming no dilution, stays the same, nothing happens. There you go. It's a good buy. But that's 10%. Right? No margin of safety, nothing above the market average. And I have my problems with that. I always say that. We haven't done the video on why I have a problem.
Yeah, we should do that video.
Well, let's do that video. All right. But anyway.
Yeah.
All right. Let's assume, for the sake of argument, That's the wrong input there. Let's assume
yep,
yes.
yes.
And let's assume a 3%.
Dilution 3%.
Let's do 3.2, slightly less.
Yes.
All right, right there. Boom. You can't assume it. You have to buy it at $10 to assume that share dilution, and you want a 10% rate of return. But I'm assuming zero growth. And to prove to you that saying zero growth, I will plug in zero. Wouldn't it have been hilarious if I plugged in zero and then it changed?
Yeah.
Funny.
The model would have been the almighty model would have been unreliable in that instance.
So now we're 0% growth. Some of you might be saying, that's reasonable because look at the average over the past years, 0.4%. Okay, well, we can't extrapolate from the past and assume going forward it will be the same. But for argument's sake, let's say 0.5%. Oh, that's 50%. Ignore that, guys. Just add the little percentage sign. All right, so if we think it's going to grow at 0.5%, slightly more than the past 5 years, then it's still not a buy. However, if you got it down at $10, then you could expect under these assumptions with the dilution, mind you, a 10% rate of return. Now, let's take away the dilution. I want to explore as much as possible. So if we take away the dilution, we can see it's undervalued for our assumptions, okay? And maybe let's see actually what analysts may be projecting. So they're expecting an 11%. And this is aggregated. So it's not really like all analysts. This is aggregated. So let's see what we could assume. And we're basically playing around with our assumptions here.
Yeah, because at this point it's already higher than the price. Yeah.
And well, actually, I'm not even going to do that because actually, if I play this game right now, I don't know when these analysts made these assumptions. They could have made it like a while back, so I'm not going to actually play that game. Let's continue with our own. So let's say if you want to assume a 12%, right? You want a 20% margin of safety. Another way to think about it.
Are we still assuming dilution on this as well?
Let's see first no dilution because I want to show everyone kind of like more a plethora of options, but no dilution. And let's still say zero growth. So yeah, if we assume zero growth, it's actually still there and with no dilution. So now if I assume dilution, to no surprise, it should say no. Because remember when I put 10%, it said no. Okay. So that's why, I didn't want to focus on that. So let's say no again. And let's say, is it primed for 15%? No, it's not. At the low growth. So let's start assuming some higher growth rates. Let's assume 5%. So we can see that I think it's Rob from the Popular Investor. He's invested in this company and he's bullish on this business. I can see why. Okay. Because it's cheap. This is what it's telling me. It's very cheap.
Yeah.
Because I'm assuming very low growth. Again, I'm assuming no dilution. Let's actually see if we throw in.
And now my question is the wisdom of the crowd in terms of the market right now, could they be potentially correct in the way that GoPro is priced right now? And then also, what's like the primary bullish thesis behind GoPro at the moment? Is it just the fact that it's cheap? Is it the fact that what we were talking about earlier with if they can grow subscription revenue, et cetera, so forth?
Yeah, that's pretty much where the growth that a lot of the bulls have been reading that they kind of focus on is the subscription revenue growth. So I think going forward, it could be where the growth kind of stems from. What I'm seeing here at 15% required rate of return, we'd have to assume somewhere close to like, let's see if it's 9%. So above, about 9% growth. If you can assume 9% growth, then you can assume the dilution and then you'd be fair game. You can assume this.
You still also get that margin of safety as well, which is, we always preach margin of safety on capital mindset. So
you can be somewhat wrong and still kind of come out on top. And then, I don't think it's going to make it to the highest margin of safety, which it's not that cheap. It's cheap. It's not that cheap.
I'd say about 16% you would have to assume for this one.
It was that cheap not too long ago. I should remind everyone. Let me go back the year. Not too long ago, it was that cheap.
Oh wow!
Right around the corner.
Even there as well. Around like the March period, it was even cheaper than that.
So,
no. This was in October.
Yes.
Oh my goodness.
That's what I'm saying. Yeah. This is October. So this model, if we were looking at GoPro back then, it would be telling me I can probably assume low growth rates around 10% ish. And it was right there. It was just right there. And with dilution, by the way, if I don't think they're going to be as dilutive as in the past, if I say, let's lower that to 1%. Oh, no, that's a buyback. I don't think they're going to buy back, but let's say they dilute by 1%. We were right there. We were literally right there. So the model would have been telling me, hey, look at this. You should probably buy it. It could be a good return if they can execute. Now, as far as the position sizing would have been, it probably would have been pretty low because considering some of the risk. And actually, they're not at risk of bankruptcy. So there's two separate measures that we use, the Altman Z-score, and then this other one that I customized. But we can go off of, for both of them, it says they're not at risk of bankruptcy. And I think we should go over the key ratios, and then we'll come back to the growth rates, and then we'll see if we want to make any adjustments. And by the way, everyone, this is kind of raw. We haven't looked at GoPro. So we haven't done any sort of like hardcore DD.
Yeah,
this is the video to tell us if we want to do that.
Yeah.
So current ratios and cash ratio basically have been good for a long time. This business has been, look, they nearly have a 1 cash ratio, which is fantastic. Which basically means that their ability to pay off all their current liabilities with the cash on hand. So that's very conservative. This is the most conservative of the liquidity ratios. That's why
it's
I have
my
it there.
Personal favorite liquidity ratio too.
It's not, I mean, immediate X if, obviously they can't cover that.
Yeah.
And
but
also we've covered
bonus.
businesses where the current ratio is below 1 and it's normal for that industry. Right.
Yeah.
So everything is with nuance. You got to understand the accounting differences between each industry. A lot of people make that mistake and they apply broad brushstrokes. That's why Warren Buffett has preached for a long time, don't invest in what you don't understand. So that statement has a lot of meaning behind it. And some of it goes into like, do you understand the accounting metrics? Like Buffett is beautifully well-versed in the accounting of banks. Banks are very difficult. I think we've covered, for example, Interactive Brokers, which is a bank-like company, and they're very difficult. So the average person is not going to understand banks. However, he understands banks and he's very good at that. And also insurance companies and all of that. All right. Anyway, long-term debt ratio coming down. Fantastic. Beautiful. Total debt ratio also coming down. Long-term debt to capital coming down. Everything's coming down. Beautiful across the board. So my quick peek on the summary report about bankruptcy risk and Altman Z-score seems to kind of pass the smell test. And then gross profit margins increasing. That's the story we saw. So we're seeing it in the numbers. They're increasing. They're just under 40% for the full year. They're probably just passing it just now. Earnings quality. Okay. Highlight this.
Something that I would like to bring up too with the debt to equity ratio there. It went from a 1 in 2020 all the way down to a 0.20. What that tells me is that there was significant dilution that occurred over this period. And what was that dilution? I mean, is this just a lowest cost of capital, or is this more so something else might have happened here? Because that's at least to me, I notice that's a pretty substantial drop in the two of them. So
it's small enough company. It could have been just issuance of shares to pay employees.
Okay. Yeah.
Because you have to remember too, lowest cost of capital also goes into payroll as well. So will I pay my employees with the cash on hand, or will I pay them in stock options? Stock options can probably be a cheaper way of paying someone, because the cash on hand, I need that for the business. I need that to pay my suppliers, to buy a new factory. I don't really want to do that with my stock. I may want to pay employees with my stock because it serves two purposes. It can make them invested in the business, in the longevity of the business. And two, it's not a direct cash payment. So I don't have to spend that cash in my bank account. So it can serve two purposes. So I bet you it's probably more along the lines of stock-based compensation. We would see a drastic change in stock if there was an acquisition or something like that. But there may have been one. Again, this is just a preliminary video. But what I'm going with that example is trying to show everyone you have to derive a story from the numbers. I say that a lot, but that's basically a lot what investing is, deriving stories from the numbers. The numbers are just there, but can they speak to you? Can you read them? And then can you understand what it is they mean? Anyone can just look at these ratios and say, oh, look. And then I have this here for everyone, to follow along. And if you're not catching what I'm saying, you can at least understand what's going on. Okay. So lower is better, higher is better. et cetera. And you can see improvement or not. So that's for you guys to follow along. All right. So earnings quality, pretty good the last couple of years, but now we're back into the negative territory for me.
Yeah. Which
book value,
yeah.
I don't care. And then for this one, I will care about activity ratios because they deal with inventory. So good, very good improvement. I expect this to improve as they go away from the more retail focus and they go more into the subscription focus and direct to consumer for their products as well. I expect that to get better. So it is getting better. It tells me a story. What story does it tell me? They're going more direct to consumer. They're going more software heavy, stuff like that. And that's how you can tell if management's executing well. Okay. So how do I tell going forward if they're executing better? You will see that number going lower and lower and lower. Okay. And then some people know that obviously lower is better, but then can you tell me why is that better? What are they doing? Right. So that's the story that I'm telling you to derive from the numbers. What are they doing? What could they be doing to cause that? And then there you go. It can connect with other things you were talking about. All right. So summary report, anything changed for you?
It's still not necessarily a business that I would consider investing into at this present moment in time, just right now. You like the businesses I like to invest into. I like the big mining players, grocery stores, boring businesses. And not that I have anything against GoPro. I would be interested in doing more research in it. It's just not necessarily a business that I could see making its way onto my portfolio anytime soon. How about yourself?
It'd be something. Okay, so I would be interested in keeping this on my watch list. Mm-hmm. I think there are so many good investments out there. It doesn't mean that it's a bad investment. This could actually be a very good investment. I hope our video kind of brought to light that some of the potential for this business. Except for me personally, I don't think it's for me. But I'm all for it because there are going to be so many stocks that I don't invest in that are going to do absolutely well. There's going to be hundreds of stocks, and I don't have to pick all of them. I just have to pick some of them that I'm comfortable with. So this one could very well be doing great, and then good on Rob, and then those who actually decide to execute the investment. But there's for me, it's just like I don't quite at this price. I don't quite think I can comfortably make those growth assumptions because I don't understand the full market potential. I don't understand it. So like, I don't know if they're going to grow at 5%. Is this growth, the average growth over the past couple of years, is that indicative of where they're going to go going forward? I don't know. So because I don't know that, I can't comfortably invest in it. That's where I'm at.
Okay. Well, with that being said, we are your hosts with the most, Austin and Fabio. This is the latest episode of the Capital Mindset Show. If you've liked what you've seen here today, please be sure to share the video. Really helps out the channel. And also, please be sure to leave your comments in the comment section below because what did I miss?
Or what did we miss? What did we miss? What are we overlooking? Or if we we said something that we didn't go deeper into, comment that down below and say, oh, you guys missed this part. You guys said this, but here's more information. And then other people also can read that. And
then also, if you also agree with us too, let us know. Just basically we want to create a community of investors with an ongoing discourse about these sorts of things. So please also be sure to like and subscribe to our channel. And then this is the Capital Mindset Show. We are your hosts, and take care, guys. Visit our website at capitalmindset.org as well.
All right. Have a good one.